Bid-ask spread, you can represent it as a percentage figure. A dealer might offer a bid price of 1.1250 US dollar per euro and an ask price of 1.1255 US dollars per euro. While there are a variety of ways to quote the above, the bid-ask spread represents the dealer's expected profit. So essentially, this bid-ask spread has to do with the inventory cost of the dealers, right? Keeping those inventory is risky for the dealers, right? They don't want to take that risk, okay, or get compensated, okay? The more risky situation, the bid-ask spread has to be bigger. And the safer situation, the bid-ask spread has to be safer, right? Because of the inventory value itself, okay? And then, naturally, you're going to see that this bid-ask spread is a function of information, private information that you got. More private information about this currency that you got, then the bid-ask spread will be bigger. Okay, typically this is a situation when the market is more volatile, more dangerous, and more information going on, and then the bid-ask spread widens. But how do we measure this bid-ask spread? Well, ask minus bid divided by ask price times 100%. Okay, so in this example, 1.1255 minus 1.1250 divided by 1.1255 times 100 will be your percentage bid-ask spread, that is 0.0442%. Now, this is an industry convention over here. They only talk in terms of small figure, okay, instead of big figures, right? So, what's the idea? Well, FX market, they are busy, right? They are, talking and arguing like crazy, blah, 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 blah. And your boss wants you to get some quote of it, right? But he knows the major part of the quote, which is a big figure, okay? In this example, 1.12, okay, that's big figure. And then whether it is 50 or 55, that's a small figure. So tell me only the small figure, okay, where that is, right? That's the idea, okay? I'm busy. Now, so 55, okay, that's the thing. Now, another thing we want to highlight is that bid-ask spread, okay? There's an interesting reciprocal relation going on. The thing is, indirect ask price is equal to the reciprocal of direct bid price. Also, indirect bid price is equal to the reciprocal of direct ask price. What is that? You know that reciprocal relation, right? $1 is equal to 2 Swiss franc, let's say. Then 1 Swiss franc should be a half of your, half of US dollars, right? Anyway, so the reciprocal relation always holds, but when it comes to bid and ask price, those bid and ask flips as you move down to the the direct versus indirect quotes, right? The reciprocal. Why? Because when you are buying US dollars in return for euros, right? You are asking over there, right? You're going to, not you're asking, there, when you are buying US dollars with your euro currency that you got, okay, you go to the dealer, right? You got euros, and then he's got US dollars, right? So at the bid price, okay, at the bid price, you say, for each euro that I got, $1.125, he's going to, give me, okay, US dollars, multiply it, okay. But taking the other way around, okay, taking the situation the other way around, right? You are the euro provider, and the dealer is dollar provider, okay. And to get euros, right? the dealer is bidding, okay, bidding a certain amount of US dollars to get your euros, right? In retail FX market, this is difficult to conceptualize because it's you don't have market power as an individual. The dealer over there or the banker over there in the other side of the counter, he or she has a power, right? But in interbank market, okay, they're equally powered guys meeting each other, bid and asking, right? So whatever you bid is the reciprocal of the ask in the foreign exchange market. Okay, that's what's going on over here. Notice that the reciprocal of spot exchange rate between dollar to euro bid is the spot exchange rate of euro to dollar ask. So here, let's say you got 1,000 euro, okay, as a customer in the bank, right? Go to the bank, right? And then say I want to exchange it into US dollars, right? For what? Okay, at what price? Can you do that? Bid price, right? That is the conversion rate the dealer is giving to you. Okay, 1.125, not 1.1255. Okay, that's too big. Okay, they have to make money. It has to be smaller number anyway. So the amount, dollar amount you can get is 11.25. Okay, 11.25 US dollars, right? I should have pointed over here. Yeah. Okay. And then and then for dealers, right? For the dealers, okay, on the other side of the table, what's going on is that he's giving you 11.25 US dollars in exchange for 1,000 euros, which is the rate of conversion will be the reciprocal of the bid price that they charged, right? This one, take the reciprocal of it, and it becomes this guy, 0.8889, okay? Customer buys 11.25 US dollars from dealer at indirect ask, okay? Customer sells 1,000 euros to dealer at direct bid, right? Direct bid. Anyway, so those reciprocal relation will be very handy, will be useful in the next part of the slides and the discussions, right? Remember. Now, currency conversion with bid-ask spreads, okay? Speculation in Europe, New York, right? Speculator in New York wants to take $10,000 position in the pound, okay? He faces these bid-ask prices. So, spot exchange rate, this is S, right? Spot exchange rate, dollar to pound and pound to dollar, okay? For each pound, how much dollar, and then for each dollar, how much pound. Spot rate is shown. Of course, as you move down to forward market, this S will change into 4F, right? Later on. Anyway, if it is dollar to pound, the bid price is set to be 1.2500, okay, to 05, which means the dealer will pay $1.25 for each British pound. He also is asking, 1.2505 US dollars per each pound, okay? Okay. And then he will pay, okay, if you see that the pound to dollar bid-ask prices, bid-ask quotes, right, bid-ask quotes, then he will pay 0.7997 pounds per US dollar, and he will charge 0.8003 pounds for 1 US dollars, right? After his trade, what will be his position? Investor selling US dollar at the indirect bid. Indirect bid, well, you got 10,000 US dollars. Then based on it, how much British pound could you get in this transaction? Well, 0.7997 pounds per US dollar. That is the bid price in the market. So with this dollar you got, you go to the market and then convert it into British pound at the bid price. Okay. Investor buying British pound at the direct ask price. Okay. So that's the reciprocal relation going on with the same US dollars, 10,000 US dollars. Okay, buying British pounds. Okay, same thing interpreted in different ways, right? As if you are sitting on the other side of the table, right? So there you have to divide by pound to US dollars, right? Pound to US dollars exchange rate over here, but it's ask price over there. That's this guy. And then this guy over here. In the end, you end up with the same British pound amount, 79.97. Okay, we are doing the same thing, but interpreting it differently, the opposite direction interpretation, which happens to be the reciprocal of it. Okay, so that's what's going on over here. Next, and then. Right, sample currency conversion problem. A businessman has just completed transactions in Italy and England. He is now holding 250,000 euro and 500,000 British pound and wants to convert to US dollars, right? US dollars. So his currency dealer provides this quotation. British pound per US dollar is 0.7997 to 03, which is, okay, 0.7797 bid price and ask price should be 0.8003. This 03, okay, this 03 is when it is 97 like this, okay, 97. Has to be the bid price versus ask price, right? Bid ask. Ask price has to be higher than bid price. But being 03 in the last two digits, okay, there's no other way but increasing the big digits, big figures by 1 unit, okay? And that has to be instead of 79 has to be what? 80. So that's why 8003 has to be your ask price. And here we also have the information about US dollar per euro, right? EUR. Now that is 1.125 bid price and 55 for ask price, which is your small figure only, right? So both euro and British pound, we want to convert it into US dollars, right? US dollars. What should be, what are his proceeds from conversion? Well, first thing first, euro 250,000 over here, okay, times what? The bid price into US dollar, okay, 1.1250. That's easy there, right? What is a little bit confusing is the British pound. Why? Because the exchange rate over here shown is what? Indirect quote right now, okay? For each dollar of for each US dollar, that is 79.97 pound is worth, okay? And then, or 0.8003 pound, okay? as ask price. Now, what do you need? What you need is the bid price of US dollar to British pound. Okay, what you need again, what you need is the dollar to pound spot rate, which has to be the reciprocal of this guy. Okay, 1 over this guy. Okay, but at the same time, which of these two should come? Bid price or ask price? What you need over here is bid price. Okay, what you need is a bid price, and then bid price for this has to be ask price of the indirect quote. You see that? So what you need is 0.8003 as the denominator over here. So with 500,000 pounds that you got, divided into the ask, what's that? Divided into the what's that? Ask price of British pound to US dollars like this, or with the 500,000 British pounds, multiply it by the bid price of exchange rate, which is the whole thing over here. Okay? Sounds very confusing. Oh my God, that's so confusing. Yeah, it's gonna, hurt you a lot. It's gonna be the pain in the butt in this class, right? And then so many people will get some points off, right? Get ready for that. Practice makes you perfect, I would say. So go ahead and do some math, right? All the practice problems in the textbook, please go ahead and do it. Yes. Now, he sells 250,000 euros at the dealer's bid, and buy. Is self-explanatory. Second sample of currency conversion problem. An Italian has just completed transactions in America and England. Okay, Buonasera Italia, and he is now holding 125,000 US dollars and 500,000 pounds. Maybe he's a Ferrari dealer, right? He wants to live his life nicely in Sicily, right? So torna a Sorrento, maybe like he wants to return to Sorrento and enjoy the sunlight somehow, and wants to convert both amounts into euro. His currency dealers provide the quotation like the following: British pound to US dollars, just like before, and then US dollar to euro, just like before. What are his proceeds from the conversion? Is a question here, right? Here, you got US dollars and pounds, want to convert it into euro. So for pounds, let's say, how do you convert it into euro? For US dollars, you have this quote of bid and ask prices, right? You have this quote, so life is easy, okay? For each dollar, you need to convert it into euro using the reciprocal relation over here. So you need a bid price of the reciprocal, so ask price of this guy should be there, okay? That's why you're going to divide it into 1.1255 in the future using this relation. So US dollar amount of this is nothing to worry about at this moment. What you have to worry about is this guy, 500,000 pounds, okay? The thing is, the direct exchange rate does not exist over here, okay? Oh, how can that happen? And Europe and England or Britain, they are closer to each other than they are close to the United States. How could there be no direct exchange rate like that? Of course, this is the reality. US dollars is like 80% of the FX transactions taking place in the US dollar terms. 기축통화. 억울하면은 기축통화 되시는 거야. It's like if you don't like it, well, why don't you make your currency become one of those key the key currency in the world, right? So you have to first convert it into US dollar and then convert it into euro. So based on GBP, right? Based on 500K GBP, convert it into US dollar. Okay, I want to buy US dollars, right? For that purpose, what you need is what? What you need is 500,000 euros, right? What you need is this guy, okay? What you need is the bid price of converting from what's that? The British pound that into US dollars. For that part, what you need is spot rate of. Always it's easier when you write mathematically, okay, like this. So you got 500,000 pounds. Once you multiply it into this spot exchange rate, you'll get US dollars. Okay. On the other hand, what you got over here is the reciprocal, right? US dollar in the denominator, pound in the numerator. So what you need to do, okay, what you need to do is take this guy, the ask price of pound to US dollar, the reciprocal of it, that's 1.2495, and use this over here and multiply it by 500,000 pounds, which gives you 624,750 US dollars. Make sense? Then what you do? Well, US dollar already you got 125,000 US dollars. Okay. All you need to do is just add these two things together. That is 75.9750. Okay, US dollars. Now what do you have to do? What do you have to do? Well, you have to multiply this guy by spot exchange rate of what? Euro per dollars. Okay? Spot exchange bid price, right? Bid, I say bid, right? Bid. But what you got over here is the reciprocal, which is US dollar to euro. So what you have to do? Well, take the ask price of dollar to euro and then take the reciprocal. That's going to be your bid price of euro to dollar. Then multiply it by the US dollar amount. In the end, you will get 666,148 the euros, right? So that's the calculation going on, right? Right. Good. Now, what? Spot FX trading. In the interbank market, the standardized size trade is about 10 million US dollars worth, right? I told you this is a game of, it's for the big players, big fish only, right? Not small fish like me or you and me, individuals, right? And a bank trading room is a noisy and active place. The stakes are very high. And the long term is about 10 minutes, so very quickly moving. Okay, every millisecond you see FX trading new prices, right, going on. And the trading floor looks like this, as in typical Wall Street movie like this, right? And a spot cross rates, right, is the next concept that we're going to talk about. Cross rate, well, we need three currencies, right? Always you have an exchange rate going on with US dollars, but not necessarily with the other currencies that you're interested in. For example, Korea versus Japanese yen. We are neighboring countries. But to get the right quotations, we need first reference it to US dollars exchange rate and their exchange rate to US dollars, and then use this to figure out our cross exchange rate. Japan and Korea, aren't they close enough? It has been that way. How about China versus Korea? The same thing, right? And then China versus Japan, the same thing. Now, suppose that spot exchange rate of dollar to euro is 1.05, which means for each euro, it is worth 1.05 US dollars. Okay? And the dollar to pound is 1.25, which means for each pound, investors pay 1.25 US dollars. What must be the spot exchange rate between pound and euro, especially pound to euro? We call it cross rate, okay, cross exchange rate. That should be like this. Take this, whatever is in the parentheses over here, okay? It is actually pound over euro, as you see over here, okay? Pound over euro. But for that part, the mathematics that you have to do is first, dollar to euro, okay, should be on the numerator and divided by dollar to pound. Why? You cancel each other out, okay, whatever is commonly in the numerators, right? Okay, it's gone. And the remaining parts are those denominators. And remember the inverse relation with the denominators. So the denominators should be the numerator, and the denominator of the numerator has to be the denominator. Oh my God, that's very confusing, right? But this is getting back to your elementary school math, right? So what you need is in the numerator, let me erase it again, dollar to euro, this guy, okay, should be on the numerator, and that guy should be on the denominator. And that's why we have 0.84 pound per euro as cross exchange rate. Okay, so that's that. Okay, if you set up the math and then numerator denominator, you cancel each other out, and then this kind of things. Once you do the exercise, things get clearer. Right, brute force math. That's it. Okay, pay attention to your currency algebra. If you don't like my brute force math, you can try alternative ways of doing it in the second line, right? It's your choice. I don't take points off simply because you chose an alternative approach. I can reverse engineering whatever you did in your calculation. That's just in your exam setting, show me your work process, okay, work, so that I can give you some partial credit somehow, or full credit in any case, right? If you get the right number. But anyway, make it your habit to write all your processes. So the next one is a key cross-currency rates are shown in this table. Is that a big correlation table? No. This is just a pair of, pairs of major currencies like US dollar, euro, Japanese yen, British pound, Swiss franc, and Canadian dollar, Australian dollar, New Zealand dollar, Hong Kong dollar, and Norwegian krona, is that right? Yeah, Norwegian krona. So, cross exchange rate. Well, for US dollar to the rest of the currencies, you have it, right? 80%, I told you before, of transaction volume. The euro to Swedish krona, and then the Japanese yen to Hong Kong dollars, all these kind of pairwise cross-currency rates are computed using their respective FX rates to US dollars. Make sense? Now, in your homework, you're going to work out this kind of cross-currency rates, okay? So wait for that part. You're going to enjoy it. We have an example over here, okay? We want to get cross rate, okay, of bid price and ask price between euro and pound, okay, euro and pound. How do we do that? Well, using the US dollar exchange rate, bid and ask, right? And first you have to convert it into US dollars and then convert it into the destination currency that you want to get. So from pound to euro, okay, how do we do that? Well, we want to get the bid price first, okay, bid price first. To find it, you consider a retail customer who has 10,000 pounds and sell pound for dollars and then sell dollars for euro, right? So how does that work? Well, that is using first $1.2 per pound bid price over there, okay, and then okay, bid price, okay, and then once you computed the US dollar amount, you want to convert it into euro amount, right? But you know that 1 euro is worth 1.051 US dollars in ask price, and actually what you need is how much of a euro is one single dollar US dollar is worth, right? When you are converting into euros, right? You are buying euros, so you have to use a bid rate, okay? Bid price, which is over here, and you know that this bid price should be the ask price of the reciprocal, okay? Which is this guy, right? Ask price of American terms, euro, direct quote, right? Reciprocal of it. So that's reciprocal relation is going on over here. You multiply these two, and then you get cross rate conversion rate, okay, between pound and euro. So he has effectively sold pound at a euro to pound bid price of 1.1418 euro per pound, right? So 1.1418, that is the multiplication of these two, okay, this guy, right? Next, right? So 10,000 pounds, sell at bid price 12,000 US dollars, and buy at ask price, and then 11,418. Don't get confused. You are not buying at ask price actually over here, but you are buying at bid price of the reciprocal, okay? Reciprocal relation. So don't get confused. So that's my message. Now, okay, so the bid price of converting pounds into euro, okay, that's 1.1418, and then that must be, I mean, once you take the reciprocal of it, then that should be the ask price of what? Pound to euro exchange rate, okay? So that's that. The next slide is about ask rates of pound to euro or euro to pound, right? So for this one, to find it, consider a retail customer who starts with 10,000 euros and sells it for dollars and then sells it for British pound and buys British pound, okay? Now, so how do we do that? Well, first of all, euro to dollars. So the bid price is needed over here. For each euro, you get 1.05 US dollars. That's what's going on over here. Once you convert it into US dollars, what do? Well, convert it into pounds, okay? Convert it into pounds. Well, pound to dollars, exchange rates are shown in the first rows over here. Bid versus ask. No bid, because this is direct quote, whereas what you need is indirect quote bid price. And you know that this indirect quote bid price should be the reciprocal of the ask price, okay, of direct quote. Okay, so 1 over 1.25 is what's going on over here, reflecting this. That's the same as this one. Okay, now you do the math and compute, and then you will find out that he has effectively sold euro at a pound to euro bid price of 0.85 what's that, pound per euro. Okay, so what's that? Well, that means let's see, 10,000 euros, sell euro at a bid, and then you get $10,500. Now with that, buy pounds at the ask price, you get 8,400 pounds, like that. So what you get is that the bid price of pound to euro, which is once you take the reciprocal of it, that would be your ask price of euro to pound. Okay, in previous slide you got bid price of euro to pound. In this current slide you got ask price of euro to pound by the reciprocal relation with the bid price of reciprocal relation of the indirect quote, right? So sounds confusing, okay, but one key idea is hold on to one way. Okay, consistently I've been using the bid price, okay, bid price, because I'm converting into new currency, and I'm buying that new currency, and I have to use bid price. Okay, but at certain step I have to be careful whether I'm using direct quote or indirect quote. Okay, if it is indirect quote, right, think about the reciprocal of direct quote and use ask price over there. Okay, so that kind of things had to be there. A very tricky part, right? Good to ask questions in your exams. Yes, your homework will carry this kind of problems, right? All right. Right, this is self-explanatory. Go ahead and read it. Cross rates with bid-ask spread, right? Recall that the reciprocal of the spot rate pound to euro bid is the spot rate euro to pound ask, right? Always this thing happens. And then he has bought pound at the euro to pound ask price of 1.1905 euro per pound. Bid ask quote would be 1.1418 to 1.1905. Okay. All right. Then, good. Another point that I want to make is that the bid-ask spread, the magnitude of it, right? Magnitude of bid-ask spread. When you do cross rates, right? Cross rates, the bid-ask spread will be bigger compared to the bid-ask spread that you do directly with US dollars, right? Why is that the case? Because this is a two-step procedure. Your inventory, right? Naturally, you have to worry about this inventory risk and then information risk 2 times. And so that's why your bid-ask spread magnitude will be bigger. Okay. So triangular arbitrage is conceivable based on what you learned already. Okay. The cross rate, right, among 3 different currencies. Triangular arbitrage is the process of trading out of the US dollar into a second currency, then trading it for a third currency, which is in turn traded for the US dollar. The purpose is to earn an arbitrage profit through via trading from the second to the third currency when the direct exchange rate between the two is not in alignment with the cross exchange rate. Okay. So your currency, like for example, Korean won and Japanese yen, right? Two different currencies. We have to compute the cross rates, right? Why? Because the 80% of the FX trading is done in the US dollars, right? So Korean won and US dollar, and that is very actively traded, and then the number is very reliable because the market is very efficient in that transaction. How about Japanese yen and United States dollars? Yes, it is again very frequently traded, and then the rate over there is very, very efficient. Now, what about the Japanese yen and then Korean won? Well, not as much, okay, even though Japan and Korea are very close country, that has nothing to do with this cross exchange rate, right? So we are all relying on the US dollars as a reference point. So that's why if there is some direct FX trading going on between these Korean won and Japanese yen, okay, there could be some arbitrage opportunities. If we think about the cross rates by the mechanism, okay. Now, the next page, I give you an example, right, from the textbook, 5.2. The euro to US dollar, right, euro to US dollar is 0.8833, and US dollar to Great British Pound is 1.4397 in the market. Now, Crédit Agricole is a bank in France, right? Bonjour, right, is making a direct market between the euro and the Great British Pound with euro to pound rate of 1.2712. So is there an arbitrage opportunity? And if so, how would you make arbitrage profit by starting with 5 million US dollars, right? Is a question. Well, how would you tackle this question? Let me expand. Oh, wait. I will move down here and then expand the window so that you can see me with this picture over here. All right, so triangular arbitrage. You have to draw a triangle, but what has to be that corners, right? Each corner. I will put US dollar first, okay? Because this is the central currency or key currency, right? And then here, what do you got? Euro and British pound. Okay? Triangle. Is it too small? Yeah, too small. It's okay. Should be alright. Now, okay. How about this? Good. Now, euro to US dollar. That means for US dollar, it is like this. 1 US dollar is worth 88.33 cents in euro, and then the direction of exchange is like from dollar to euro. Okay. How about US dollar to Great British Pound? Well, that is this way, right? The currency on the numerator has to be the starting point of this arrow, and then going to US dollar, right? So start with Great British Pound, and then multiply 1.4397, right? And you will get US dollar amount. 1 pound, 1.4397 US dollars. And 1 US dollars, well, 0.8833 euros, right? Now, Crédit Agricole is a bank, and they're making a direct transaction over here between these two, okay, instead of going from here to there. Now, the euro to Great British Pound is the ratio is 1.2712. Again, the direction of arrow has to go from pound, the denominator currency, to euro, the numerator currency. So 1 pound is worth 1.2712 euro. Make sense? So is there an arbitrage opportunity? Is a question. Here it is, Credit Agricole offering this kind of exchange rate. Okay. So how would you tackle this kind of situation to identify these arbitrage opportunity? The idea should be, well, starting from this, right? This currency exchange rate, okay? So starting from pound to going to euro, you have two different ways. One way is going Credit Agricole way, okay? Go to Credit Agricole, put your British pound, and then get euro, okay? The other way is going through US dollar currency way, okay? So cross exchange ways. So going this way, number 2, right? So if the market is efficient or there's no arbitrage opportunities, let's say, okay? If there's no arbitrage opportunities, then these two ways should give you the same exchange rate, okay? Is that really the case? Is a question, okay? So how would you do it? Well, the thing is, this one is pound, this one is dollar, right? So the next slide shows you this, right? Good. So euro to Great British pound, right? Euro to Great British pound. So euro to Great British pound. What's the exchange rate? Well, you need to figure out this guy. $2. Make sense? Right? Why? Because the denominators gets cancelled out, the numerators remain there, right? But for that purpose, what do we need to do? Well, think about this guy, right? Euro to dollar, that's what we already have, right? Can you see it? I should turn it around a little bit. Okay, so that's what we already have. That's good. How about the denominator over here? Do we have it? Okay? No, we don't. We have the reciprocal of it. Okay, reciprocal of it. So 1 over 1.4397, okay, is only available right now. So we have to take the reciprocal of it, okay? Then it gives me 1.2717, okay? Is that the same as 1.2712? No, okay? No. And the magnitude of difference is 0.0005, right? Euro per pound. And you may say, that's so minimal, that's so too small difference. You might say that. But that's not. Remember the basic unit of FX transaction? We are talking about $10 million magnitude. 10 million. So multiply this guy by 10 million. Then 1, 2, 3, 4. 1, 2, 3, 4. So 5,000, right? $5,000 or euro, right? 5,000 euros opportunity per transaction unit, right? So this is non-trivial issue. Okay, this is non-trivial issue, and there is some opportunity to arbitrage away. Okay, arbitrage opportunity is there. Okay. Now, and looking at this, okay, this means Great British Pound is too low relative to euro compared to non-arbitrage FX rate. So there is an arbitrage opportunity, right? There is an arbitrage opportunity. So this guy, Credit Agricole, okay, they evaluate euro is very expensive and pound is very cheap, right?
So what do? Well, go to at some point, okay? At some point, you will have to go to Crédit Agricole, and here's euro that you evaluate as very expensively, and then you give us a rich amount of pound in exchange. So here's euro, give me pound, okay? So that you will have more pounds in your pocket later on than the pound amounts that the arbitrage free market will give you, okay? Taking advantage of Crédit Agricole. So that's the strategy here. But to do that, what would you do? Well, let's start with US dollar 5 million US dollar. Okay, 5 million US dollar. And okay, you are starting with 5 million US dollars. I'm gonna take this off. Alright. And then what do you do? Okay. Remember, you will have to exchange into what's that? Later, you will have to go to Crédit Agricole and give euro and get pound. How would you do that? Well, run this way round. Okay, one full round. And then round trip, how much would you end up? Okay, would you end up with more than $5 million? Is a question. So let's do it. So first you convert it into euro. So it's just too weak. All right. So 5 million US dollars, right? Can you see it? Good. Right. You see it? Right, 5 million US dollars times 0.8833. That is 5 million times 0.8833. So that's this guy. Can you see it? No, 416,500 euro, right? Euro. And then bring this, you get, right, euro 4.416 million, okay? And then convert it into pound. Then how much would it be? Well, let's go. 4,416,500 divided by 1.2712. So euro, this guy is euro to pound, right? So euro cancels, pound is left. Okay. Divide this guy by 1.27. Okay. So, oh, no. Times 1. Okay. Divide this guy by 1.27. 1, 2. Yeah, we have to be careful about it until the last digit. Right? So that gives me 3,447,4276. Okay? Always you have to be careful about the numbers here. Alright, so you get here pound of 3.474 million about. Then go this way and then exchange it into US dollars. So finally you will get 3,474,276 times 1.4397. That is, let's see. So we kept this number times, right? 1.4397, and right, voila, you got more than $5 million, right? You see, this is 5001915 55, okay, cents. So you end up with, okay, 5.1915 or 16, should I say? Rounding up. Okay? So you got a profit of 19,000, what's that? 1,900, okay? 1,900 US dollars worth. The profit is this guy. Profit of 15.55. Okay? So, 앉은 자리에서, at the sitting point, and then just run a one round trip transaction, and you got $1,900 in your pocket. Happy? Yeah, happy. All right. So that's how we take the arbitrage opportunity. What if you ran a wrong direction? Okay, starting from US dollars and then convert it into pound and then go to euro and then bring it back to US dollars. What would happen? You will lose equal amount of money. Okay, you will lose equal amount of money. Instead of profit, you will have loss over there if you run the wrong direction. Okay, so that's how this triangular arbitrage works. But foreign exchange microstructure, right? Market microstructure refers to the mechanics of how a marketplace operates. Why do you call it micro and then structure, right? How the market is structured in very, very micro sense, right? Guess how many times the foreign exchange transactions take place, okay? How frequently? Well, every millisecond, right? Every millisecond somebody is trading, okay? And trading, it means buying and selling, and the market of supply and demand happens at every moment, right? And then buying and selling based on those bid-ask quotes, and then the bid-ask spread, how do they get structured, right? How is it explained? And all those kind of things are called microstructure, market microstructure. The bid-ask spread is the most important concept over there, okay? In the spot FX market, this bid-ask spread is a function of inventory cost and information. Okay, inventory, whose inventory? As I said before, the dealer's inventory, right? Keeping US dollar in my, vault over there, right? What if the value of US dollar goes down like crazy or goes up like crazy? Okay, all these kind of things. And information, right? It also matters, right? If I have some bad news about the inventory value, right? That nobody has yet, right? I may take advantage of it, and that kind of things show up in the bid-ask spread. And then it increases with FX exchange rate volatility, so more riskier market, right? Then you tend to keep, higher bid-ask spread so that the dealer doesn't get hurt. And then it decreases with the dealer competition, right? Because this is a profit margin kind of things for them, right? Perfect competition, no profit margin there. That kind of idea goes there. Now, private information is an important determinant of spot exchange rates. If you go to PhD level studies, right, the market microstructure would be a whole lot of subject to study, okay? But in undergraduate international finance level, I'm not going to test you too much on this one. Don't worry about it. Number two, if you go for quantitative or high frequency trading market, right? After undergraduate, right? You should study more about market microstructure, robot trading kind of things. Because buy and sell orders, right? How would you make your orders to take advantage of the market? Well, you need to understand the microstructure a lot more. But
for general purpose right now, you don't need it. So that's that. Forward market is the next thing to discuss. The forward rate quotations, we're going to talk about it, and long and short forward positions. We're going to talk about also non-deliverable forward contracts, or 여부의 선물 환생 in Korean terminology, and the forward cross exchange rates. Of course, spot cross exchange rate we studied, so why can't we do it for forward cross exchange rates? Yeah. And then forward premium and then discount, right? We will study, and then we're going to talk a little bit about swap transactions. So forward, okay. The forward market is the FX. Is for FX involves agreements to buy and sell foreign currencies in the future at prices agreed upon today. Okay. Again, the forward market for FX involves agreements to buy and sell foreign currencies in the future at prices agreed upon today, right? You fix a price. And then why do you do that, right? Why do you do forward contract? Well, because you want to hedge some price risk in the future, right? The concept of forward, as you all know, who took investment class, right? Or derivatives class. Actually, if you have taken in the derivatives class, you must be the mastermind of this international finance class as well. The history of forward even goes back to like 1,000 years ago. Okay, they say Japan, right? They were producing rice, right? The farmers. What is the risk that a farmer faces? Well, farmers, you have to work hard like crazy, right? All year long, right? All year long, and then produce rice, this crop, right? But at the end, what if the market turns out to be there's too many rice in the market. Too much rice, not too many, you can count it, right? Too much rice in the market, so much so that the price of rice goes down like crazy. Well, that's a price risk that you face, right? So what do? When you're beginning, right, in the springtime, you make a forward contract with a buyer, potential buyer, okay? Like a corporation, maybe these days, right? CJ, who produces what? The rice, kind of rice meal, right? Instant rice meal. Well, you make a contract with this kind of guys and say, at a fixed price, we're going to sell our rice to you. The whole rice field that I have, okay? I'm going to give it to you at that fixed price. Forward contract happens, right? What if the price shoot up like crazy at the end of the year, right? Well, tough luck. You already got into that forward contract, okay? There's upside and downside lockdown. I mean, not lockdown. There's a price range, or price itself is fixed, so that it's kind of hedging tool in that way. Always, that risk has two sides, right? Upside and downside. So you're staying away from that, both of upside and downside. Anyway, when it comes to foreign currency, similar situation happens. Similar situation happens. Now, I have to. So, for foreign currencies, you do the same thing, forward contract with a counterparty that you find, okay? And then, by the way, did I say most of the foreign currency FX transaction, it takes place in the OTC market, which is like over-the-counter market, over-the-counter. What is that? Well, think about stock, right? Equity stock, right? KOSP, KOSTOCK, all those stocks, New York Stock Exchange, Tesla Motor stock. Those kind of stocks you buy and sell in a public exchange, right? Not OTC, not over the counter, but through an exchange. For that purpose, well, what has to hold? Well, the products that you buy and sell has to be very standardized, okay? so that millions of people will commonly understand this, the important features of each product. For example, one share, okay, one share of equity, and then it gives you the right of dividend in the future, right? Very easy, okay? Whereas those products like a corporate bond, okay, corporate bond, well, they don't trade in exchange usually, okay? They don't, some of them, small number of them are traded in the exchange, American exchange or something, Amex kind of things. But usually most of the 99% of corporate bonds are traded over the counter, which means there is no exchange, but you have to call, right? You have to call and then make a transaction. You have a excess amount of corporate bond, you want to sell it to somebody. Well, you call up a broker, okay? And then the broker will connect you to potential buyers. So search is a very important thing, right? Search cost is there. And this is a part why the bid-ask spread takes place, right? The brokers or dealers, the middlemen, right? They have to be, you know, finding all these guys, and then you have to be appreciating their work. So pay those spread to them, right? Now, over-the-counter concept, right? Over-the-counter. Foreign exchange as well, okay? And then bond market, I didn't finish the discussion yet. Bond, why isn't it traded in exchange? Well, the bond itself, right, is not standardized. Is not standardized. For example, stock had no maturity, okay? Stock, no maturity at all. It's infinite life, you assume it. Quite standardized a way of doing it, okay? But bond, right? The maturity varies a lot for a single company, right? Samsung Electronics may issue a bond that matures in 1 year, or 3 years, or 20 years down the road. And then which product are you talking about, okay? Is very difficult. And then face value, okay, of one security, bond, right, varies a lot, okay? Some companies issue it at $1,000 per note, and some companies will go like $1 million or something. So there's no standardized features in corporate bond market, so that it is impossible to trade in exchanges, okay, open exchange. So it has to be over the counter, right? Foreign exchange is similar in that sense, because the amount of trading and then the features of these exchanges, right? Foreign currencies, it is hard to standardize, right? Especially also the forward rate, okay, forward market also, like how long and all these kind of things, right? For the same currency, right? It's not standardized, but it's you know, time varies a lot in that sense, and then a lot of different features are there for you. So anyway, these market is operated in over-the-counter market fashion, OTC market fashion, right? Now, bank quotes for 1, 3, 6, 9, and 12 months maturities, and these are available for readily available for forward contracts, and long-term swaps are available. Okay. Now, right. Consider the exchange rates shown to the right. For British pounds, the spot exchange rate is what's that? This guy, 1.4402 per pound, while the 6-month or 180-day forward rate is 1.4416 per pound, right? What's up with that? Well, you see the difference over here, 0.2 and 1.6. Increase or decrease as the time interval goes on, 6 months down the road, right? It goes up. It means that clearly the market participants expect that pound will be worth more in dollars in 6-month horizon. Okay, so typically we call it pound is in premium. Okay, we're going to compute the premium and discount going in a couple of slides later, and then and then this reflects, as you see, the investors' anticipation about what's going to go on. Okay, what's going on in the British economy as opposed to U.S. economy. Okay, right. If you look at U.S. How do you say indirect quotes, right? You will see the opposite movement, right? That means the flip side of the same coin. Okay, investors are anticipating the U.S. currency value will go down slightly with respect to British pound. Okay, so that's something worth noticing. Then let's go. There. All right. Now forward rate quotation, dollar-based holding period return. Right. Consider a holding period return of a dollar-based investor who buys $1 million at the spot exchange and sells them forward. Okay, what would be their holding period return? Okay, $1 million purchased at 14416. Okay. Oh wait, in forward rate, and then the spot market 14402 in the spot market, right? Shall we go back to previous slide? Yes, using this spot rate and forward rate. So if you got into a contract, right? You're selling at the forward price, and then you're purchasing at the spot price, right? Then the holding period return that you expect, right, is 0.097%. Okay, the way we compute the return, holding period return, is the same. Okay, your starting point, initial investment. Okay, initial investment should be your denominator, and then numerator has to be your final price. Okay, end of the period price that you sell it for minus the initial purchase price, right? So that's the holding period return. And then that's 9.72 basis points, right? And remember, this is a 6-month horizon, okay, 180 days horizon. And then can we annualize it, right? Then you have to just multiply by 2, because here we follow bond market convention that 1 year has 360 days instead of 365 days, okay? And then 6 months is just half of it, 180 days, right? So 360 over 180, that's 2. That's why we have 2 over here, so annualize. All right. Good. Forward premium. Okay, forward premium. Well, interest rate differential implied by forward premium. Interest rate differential is implied by forward premium or discount. For example, suppose the euro is appreciating from 1.13321 per, how do you say, dollar per euro to $1.1389 per euro in forward market 6-month horizon. Okay, so in the 6-month horizon, the euro is in premium relative to dollars. So what's the premium magnitude? Okay, magnitude of the premium, the forward premium. We can compute it. Okay, just like what we did for the return itself, right? So forward rate of dollar per euro minus spot rate dollar per euro divided by spot rate dollar per euro. Quite similar. Yeah, holding period return. This is kind of equivalent concept. And then multiplied by 360 divided by holding period, which means annualizing the premium. Okay, we always annualize when it comes to computing premium or discount in forward market like this. So what you'll get is 1.2%, okay, premium. right? So that's what you do. Okay. Long and short forward positions. Well, if you have agreed to sell anything, okay, spot or forward, you are short, we say it. And then if you have agreed to buy anything and in forward or spot, you are long, okay, long short position, we take it, long short position. So if you have agreed to sell an FX forward, you are short. And if you have agreed to buy an FX forward, you are long. Okay? Long position, short position. It's a quite common terminology. Now, what's the profit or payoff, right? Forward contract payoff at the end of the day, okay? At the end of the maturity, let's say, okay, 6 months. Well, what happens at the 6 month end, right? Ending price. Depending on the ending price, you may end up with profit or loss, right? Profit or loss. And then this diagram, what you see on the vertical axis is the profit versus loss of your forward position. And then what you see on the horizontal axis is the spot exchange rate in 6 months, dollar to pound, okay? Consider the payoff at maturity to a long position in a 6 month forward contract on 10,000 pounds purchased at 1.4416 dollars per pound, dollars per pound. Yeah, okay, fine. 1.4416, that comes from these forward rate that you see. Okay, this is readily available as an information. Okay. Of course, OTC market, you can make a forward contract besides, other than this 6 months or 3 months, let's say X month, right? It's up to you, okay? Depending on the counterparty that you can find, right? Anyway, so this is the contracted price, right? 1.44. So at the end of 6 months, if the spot price at the end of 6 months, right, turns out to be 1.4416 exactly, then you will be break even. Make sense? And if, wait a minute, a lot of pop-ups going on in my computer. Anyway, good. What if the spot exchange rate becomes $1.5 per pound at the end of 6 months? Well, you're gaining something. So the difference between these two, okay, 1.5 minus 1.4416, okay, let's see, yes, to show you, 1 point, can you see it? 1.5 minus 1.4416, right? 16, right? Yeah, should be this guy, right? Oh, no. 1.5 minus 1.4416, okay? So that's 0.05840, right? This guy. And now you multiply it by the pound unit, 10,000 pounds. So you get a profit of 584, right? This guy. That's your profit, okay? Payoff to you. And on the other hand, what if, end of the day, like at the end of 6 months, the spot exchange rate turns out to be 1.4. Oops, you're losing money, okay? So by how much? Well, that's 1.4 minus 1.4416 should be equal to, I should find a way to show it in a nice way. Okay, just simply multiply it by 10,000, right? That gives me 416 dollars lost, right? So that's how we compute the profit and loss, right? Next, now there is something called non-deliverable forward contracts. In Korean terminology, this is called something called 여구의 선물환. Due to government-initiated capital controls, the currencies of some emerging markets countries are not freely traded. So the principal amount, keep it at the country. Don't give it back and forth. Okay, this is just your forward contract. Well, think about only, give the money of profit and loss only, this kind of things. The principal amount, keep it. So for many of these currencies, trading in non-deliverable forward contracts exist. Okay, a non-deliverable forward contract is settled in cash, usually in US dollars. Settlement is calculated by the differences between the forward price agreed to in the contract and the spot price at maturity of the contract multiplied by the contract size. So as I said, principal amount, don't touch it. The difference, okay, gain and loss, only that amount should be transacted, okay? That's over different countries, right? So that's the idea. Now, forward cross rates, also you can conceive these kind of things, right? And it is also there for you. What about here? You see the table of US currency to euro and US currency to British pound. What about the forward rate between euro and British pound? Well, if, for example, the 3 months forward of euro to pound cross rate should be like this. You see dollar to euro, okay, that you see on the left hand side, dollar to euro, and then pound to dollars, right? Forward exchange rates. Then you multiply these two, then what is happening will be like canceling the dollar out, right? And then what you get will be, what's this? Pound to euro cross rate. Pound to euro. Was that something I intended? No, actually, sorry, right? This one has to be the inverse of it, okay, 0.7881 should be, right? So if you do the math, right? So how do you get to 0.788? That's just simply multiplying the forward rate of dollar to euro, 1.1353, okay, divided by 1.4407. 1.1353 divided by 1.4407, like this, okay? So that equals this guy, 0.7880, right? So what's the problem with this one? Well, this is the reciprocal of what we want to get at. What we want to get at is the forward cross rate of euro to pound, not pound to euro, okay? So you have to get the inverse of it, this guy over here, okay? Again, so 1.2690 should be your answer. 1.2690. Is that right? Yes. So that's how it works, okay? Excuse me, just to make sure that you are awake, okay? Yep. All right, currency symbols, right? Hundreds and 300 different countries are there, right, in the world. So there must be a lot of different currencies, hundreds of different currencies. And in addition to the familiar currency symbols like pound, yen, euro, and dollar, there are 3-letter codes for all currencies. It is a long list, but selected codes include excuse me, Swiss francs, CHF, British pound, GBP, South African rand, ZAR, Canadian dollar, CAD, and then South Korean won, KRW. Don't ask me North Korean won, I don't know. And then Japanese yen, JPY. Don't get confused with JYP. I think JYP is getting more popular these days than JPY. I'm just kidding. Anyway, so don't get confused. And Sing dollar or Singapore dollars, SGD, right? And then Hong Kong dollars, what's that? HKD, right? Australian dollars, AUD, right? Just you name it, and go ahead and find it in the Google, right? So that's that. Swaps, right? And this is going to be, one of your questions about in your homework, by the way, right? Because there was as I said before, important swap contract with between Korean government and U.S. government, not the government, but the central banks, right? A swap is an agreement to provide a counterparty with something he or she wants in exchange for something that you want. Okay? Here's my Korean won, there's your US dollar, swap it for a certain period, and then bring it back. Okay? That's what's going on. Often in a recurring basis, they do it every 6 months or every 5 years. And then swap transactions account for approximately 56% of interbank FX trading, whereas outright FX trades are 11% only. So swap, the size of the trade, right, is huge. And swaps are covered fully in Chapter 14, so you can wait a little bit, okay? But the homework is there for you, okay? Exchange traded currency funds. Well, as you do some stock market trading, right, you must have seen something called ETF, exchange traded fund. This is a kind of a mutual fund, but it's rather, really a passive fund following any kind of index or the financial instrument they claim to follow. Okay, so KOSPI index ETF. Well, this ETF is a mutual fund kind of things that is, having all mutual fund that has all kind of asset, all kinds of stocks in the KOSPI index components, right? Likewise, they create ETF of all different kinds, and here you see ETF chasing after foreign currency value. So individual shares are denominated in the US dollar and trade on the New York Stock Exchange. Or you can think about the same thing equivalently in Korean market, right? And consider an ETF where each share represents 100 euros. The price of one share at any point in time will reflect the spot dollar value of 100 euros plus accumulated interest minus expenses, right? Minus expenses that, operating costs, right, that they have to cover. So you have to pay it. So minus cost, minus expense, that's understandable. And then accumulated interest, what does that mean? Well, you keep that money, right, in the fund. Then that fund does not lay lazily, right? They have to be put in certain interest incurring investments tools, right? So that there will be some interest incurred, typically money market fund or something. Anyway, so those interest incurred minus expenses, right? And that added to the original amount, right? That would be the value of ETF. 6 additional currency trusts exist on the Australian dollar, British pound, Canadian dollar, Mexican peso, Swedish krona, and Swiss franc in the US. And currency is now recognized as a distinct asset class, like stocks and bonds, and currency ETFs facilitate investing in these currencies. So if you yourself, if you wonder, okay, or if your parents ask you, oh, you learned finance, international finance, and nowadays the Korean won seem to be, going to toilet, the value of US dollar shoots up like a crazy, going to like a 1300 won or beyond, right? Do we have to switch our money out of Korean won into and buying into US dollar together with them? Well, first thing, number one, tell them, don't worry. Our Korean central bank, it has a lot of swap contracts with other countries, like major currency countries like the US and China, and then, except Japan, by the way. I don't know why. And then, so the FX rate will be stable, compared to 1997 or something. Don't worry. But number two, if you're so afraid, okay, then no need to exchange your money and get caught by the police, right? In Korea, okay, if you exchange, not the police, but the IRS, the tax agent, right, of the government, if you convert more than $10,000 worth of Korean won into any other currency, especially US dollars, right, in a day, okay, in a day, more than $10,000 worth, then the IRS will raise their eyebrows. What? And because by law, the bank has to report, okay, to the IRS, right, tax, 국세청, right? Here are some guys who is, switching out of Korean currency and then buying into US dollar. Okay? Then later on, you may get, 탈탈 by the IRS, right? So you don't want that kind of situation. So what do? Well, ETF is there for you, okay? Just go to the Korean stock market and then invest in some Codex kind of US dollar ETF kind of things, all right? So that's one practical advice for you. Anyway, summary. Well, we talked about the spot rates and then the market convention and then forward rates and then cross rates and bid-ask spread, all these kind of things. So those are something you have to read it, right? Very self-explanatory, right? Good. So that's the end of my lecture today. So I hope you enjoyed it. And then any question that you got, please ask me through the email address that you see below over here. Make sure you subscribe to my YouTube account, by the way, and then so that you will keep updated with my additional videos, right? Your homework will be assigned to you, and which will be fun to do, and then will help you, right, to understand this turbulent world better in financial ways, right? See you next week, right?